Commodities futures markets exist solely for the benefit of bona fide physical hedgers, not for speculators. The futures markets provide physical hedgers with two vital functions: price discovery and risk hedging. In fact, producers and consumers in the energy markets price nearly all spot market transactions at the futures price plus or minus a differential. As an example, a heating oil distributor buying from their local wholesaler pays the NYMEX futures price minus a local differential. That means that when the futures price rises by $1, then the spot price will also rise by $1. Price changes for energy commodities originate in the futures market and then are transmitted directly to the spot markets. So what happens in the futures markets does not stay in the futures markets. Index speculators, a group that I define in my written testimony, have driven up futures prices and damaged the price discovery function. Slide 1. Index speculators have poured billions of dollars into the commodity futures markets, speculating that commodity prices will increase. As the slide shows, assets allocated to commodity index trading strategies have risen from $13 billion at the end of 2003 to $260 billion by the middle of March of 2008.
Would the gentleman suspend? Mr. Chairman, could you have the big screen put down?
We're just talking about that.
Because I can't see that.
Right, what's the glare that's hard to see? Kyle, could we get the big screen down?
Thank you, Mr. Chairman.
Hang on, Mr. Masters, so we can get it up there. And you're into this modern technology. You call it video barrels. You call it paper barrels on this side, so we're still a little slow yet. Kyle, can you put that up on the back screen? It'll take just a second. It's got to warm up. Need a little energy.
Like me.
Well, we'll get going here. It's on page 5 of Mr. Masters' testimony, that same chart, if you want to follow along. Mr. Masters, if you want to continue from where you left off. Thank you.
Sure, thank you. As you can see from the chart, the prices of the 25 commodities that compose these indices have risen by an average of 183%. Index speculators have bought more commodities futures contracts in the last 5 years than any other group. If they have been the largest buyer of futures contracts, is it not reasonable that they would have had one of the largest impacts on futures prices? Importantly, physical hedgers are motivated by only one thing: risk reduction. Producers and consumers only trade futures in order to hedge their actual physical production and consumption. Their trades are always based on actual supply and demand fundamentals that they are experiencing in the real world. Their trading decisions strengthen the price discovery function. In contrast, index speculators invest in a broad basket of commodities and therefore do not express a view on any single commodity. They do not trade based on underlying supply and demand fundamentals. Therefore, their trading decisions damage the price discovery function. In fact, if a pension fund decides to allocate $100 million to a commodity index, the $40 million that consequently flows into West Texas Intermediate crude oil has nothing to do with the real-world supply or demand for crude oil. Every single WTI futures contract that is traded for any reason other than the supply and demand of physical crude oil is a contract that weakens the price discovery function. In 1998, physical hedgers outnumbered speculators by a 4-to-1 ratio. Today, index speculators are the 800-pound gorilla that dominates the futures markets. Together with other speculators, they now outnumber physical hedgers by a 2-to-1 ratio. There are 3 steps that Congress can take to immediately reduce excessive speculation and strengthen the price discovery function. First, I recommend that Congress convene a panel composed exclusively of physical commodity producers and consumers for every commodity. This panel should set hard and fast speculative position limits at the control entity level. These limits must apply to every market participant, whether they directly access the futures markets or trade in the over-the-counter markets through swaps and other derivatives. Second, the panel should numerically define what exactly constitutes excessive speculation as a percentage of open interest. Third, Congress should eliminate the practice of investing through passive commodity index replication because of the damage that it does to the price discovery function. Another avenue might be found in the Commodities Exchange Act, which states, when discussing speculative position limits, that, quote, such limits upon positions in trading shall apply to positions held by and trading done by two or more persons acting pursuant to an expressed or implied agreement or understanding the same as if the positions were held by or the trading were done by a single person, unquote. Since index speculators are all acting in express agreement by following the exact same index trading methodology, they should all be collectively subject to the speculative position limits of a single speculator. If this provision of the Commodity Exchange Act were enforced, then the amount of money allocated to index replication strategies would have to drop from the current level of $260 billion to the limits of a single speculator, approximately $4 billion. In closing, it is important to realize that Wall Street is very good at inventing and promoting novel investment strategies. Unfortunately, they are not good at foreseeing the long-term consequences of the instruments that they create. The recent subprime debacle, which has now grown into a worldwide financial crisis, shows us where unbridled financial innovation can lead. This concludes my testimony.